following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, and welcome back to the Advisor's Option, the show where we break down options into their rawest and purest form for you, the financial advisor or the asset manager who are interested in adding these products into your portfolios and into your clients' portfolios. And joining me on the program today, first up, beaming in all the way from the great state of Colorado, where it is indeed the heart of ski season, so we're glad he can make some time for us. He is Randy Swan, the founder, or should I say co-founder, of Swan Wealth Advisors. Randy, welcome back to the show.
Thank you very much. I hope everyone had a good Christmas this year.
So ski season is something's unfolding well for you guys out there in Colorado, a little bit better than last year, I think.
Well, we've had a really good couple snowstorms over the last week or so. So, yeah, skiing is on. It's a good time of year if you live in Colorado.
And also joining us on the show today is Alan Grigoletto. He is the Vice President of Education over there at the Options Industry Council. Alan, welcome back to the program.
Well, thank you very much, Mark. Always a pleasure to be here, and always a pleasure to join my colleague Mike and Randy on the show. Thank you.
And last but certainly not least, we have the man holding down the fort over at Know Your Options, Inc. He is Mike Cavanaugh, a regular on our network and a regular on this program. Mike, welcome back to the program, to you as well.
Great to be back. Happy holidays. If I'm the one holding down the fort, I would worry about how long the fort's going to be here.
You sell yourself short, sir.
Yeah.
All right, with the team assembled, we're going to dive right into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to Options 101. This is the portion of the show where we walk you through some basic options concepts and introductory principles to help arm you with the knowledge you need to properly implement these products in your clients' portfolios. And we've hit on a number of individual options components on our previous shows. If you're just joining us for the first time, I recommend you, by all means, go back and download our earlier programs where we walk through some basic options concepts like buying protective puts, writing covered calls, buying calls, and buying individual puts, married and otherwise. Of course, we talked about the mother of all advisor strategies on the last show, the collar. And today we're going to take that concept and play with it a little bit. We're going to dial it back and talk about perhaps the one concept that sets options and indeed derivatives apart from all other asset classes. It's the one thing that really, really makes these products unique. And when a lot of people come to our site at the Options Insider for the first time and start learning about options, it's what really tends to open their eyes to the possibilities of the options product, and that is spreads. And spreads are really just very basic step up from the individual options concepts we've talked about on previous shows. I know in our early shows we talked about, for example, buying a call and the various leverage and other benefits that can offer to your clients, buying a put and the various protective aspects that can offer to your clients. We're going to take that one step farther now and talk about how you could add spreads to your portfolio. First off, very basic definition. What is a spread? Typically, a very simple basic definition of a spread is just you're buying one contract, which is referred to in options parlance as a leg, and then selling another contract against it, which is also referred to as a leg. The most common introductory spread a lot of newcomers to options find themselves utilizing is the simple vertical spread, which is in the case of looking at an options expiry month, also known as the options chain, and you're seeing a lot of strike prices there. You're going to buy one call option at a particular strike and then sell another call option at a strike above it, hence the vertical term. And that is where I think a lot of people first start off when they're first using options and first cutting their teeth, as you will, with spreads. Now, Alan, Mike, and Randy, you guys obviously make a living implementing spreads and teaching people about spreads to a varying degree. So when you first start broaching this subject with your clients or with your students, what are some of the let's hit on the advantages and disadvantages first of using spreads. Obviously, there's a lot of benefits to actually using these as opposed to buying or selling an option outright, and that's probably, I think we'll start there. Maybe Mike, we'll start with you. Let's say your individual client is coming to you looking to add a little bit more advanced strategies to their portfolio, and they're thinking about doing spreads, and they're asking you what these products, what these strategies bring to their portfolio. What do you sit down and walk them through when you're doing this for the first time?
Yeah, and the beauty and the timing's impeccable. To talk about a vertical spread the week after we talk about a collar is impeccable, because if you look at a vertical spread in any like trade calculator or analyzer on a brokerage screen, we start the people with call vertical spreads, which essentially has the same risk profile as a collar. So basically what you get to say is, hey, dear client, define your sentiments on this particular issue. So let's just say it's Apple. Everybody seems to trade Apple. I'm bullish Apple over this time period. Great, Mr. Client, you don't have to outlay all the capital to buy the stock and buy the put and sell the call. We can put up XYZ amount of money to buy this call and sell this call, and you basically have a floor and a ceiling on what you can lose, which is the premium that you pay for that vertical call spread. So with Apple trading around $500, let's say you bought the 520 call and you sold the 530 call, and you paid $2 for it. So the most you can lose is $2. The most you can gain is $8. You have a floor, you have a ceiling, and it's a great place to start defining risk, showing people what their sentiments, how their sentiments can play out in a capped risk loss scenario, gain risk scenario. So that's kind of where we start when we start with spreads, is the vertical call spread. You can get tricky, and if the client's sentiment is down, if it's bearish, the same concept applies, except you buy the put closer to the money and sell the put that's further out of the money in the same month, a vertical call or vertical put spread. And it helps us educate the client. If you're an advisor listening, it helps you educate the client as to, here are your sentiments, here's the most you can lose, here's the most you can gain, and that's where we start.
Let's start there as well then. I like the vertical call spread, you like the vertical call spread. we'll walk our listeners through a quick example so they know exactly what we're talking about. You mentioned Apple. I like Apple. I also like to dovetail back to my favorite stock, the name I've made countless fortunes on, and of course lost countless fortunes on. That is, of course, XYZ. I think we all have some heartbreaking stories of trading in XYZ. But yeah, let's say we're looking at XYZ trading around 100, and you're looking at an XYZ 100 call. You're bullish, obviously. You're looking at the 100 call trading for about $3, the 105 call trading for $1. You can, of course, go out and just buy the 100 call, spend the full $3, and then you have all of the upside potential, the limited risk we talked about on our earlier show of just buying a call outright. But now today we're adding the vertical spread component. So instead of just buying the 100 call for $3, we're going to turn around and sell the 105 call for $1. Now, what does that do? A couple of different things. The obvious benefit is right off the bat, you've cut your premium outlay by a third. So you're going from $3 down to $2. Now, multiply that times all the different portfolios you might be doing it and the actual size of your positions, and that's a substantial reduction in premium. Now, how does that position perform? Well, let's say your XYZ stays at 100 or drops below, down to 95. Well, both of those calls are worthless. You've lost essentially your entire investment unless you got out of it earlier. Hopefully you did. But in the case of buying the call outright, you would have lost $3. Instead, by doing the spread, you've only lost $2. So you've cut your losses there. If the stock rallies to 105 or above, now you have a situation where this spread is actually at its maximum value. So let's say your stock's trading right at 105 at expiration. That $100 call, you bought it for $3, it's now worth $5. The 105 call is worth nothing. Your spread is now worth the difference. Obviously, the calculation of that spread is by the differential of the two, the price of one minus the price of the other. Therefore, you're at that maximum value of $5. So you've achieved on that $2 investment you've made, you've now turned it into $5. So the return on your outlay is also significantly higher. Of course, the one downside to spreads is, of course, pun intended, is, of course, that if XYZ were to rally to 110 or 120, would to have an extreme upside movement, you've, of course, capped your participation at that full $5. So if you're in a name where you think there may be a substantial amount of very, very near-term upside, you're trading perhaps some biotech name that could have an FDA announcement tomorrow, perhaps a vertical spread is not the solution for you. But in most other scenarios, a vertical spread is an ideal way to get your feet wet trying spreads and to reduce the premium outlay for your customers and for your clients. Now, Randy, obviously you do a lot of overlays and different strategies over there at Swan. What's your take when you're first, let's say you're talking to an advisor is talking to you for the first time about perhaps sub-advising with them, or perhaps your mutual fund and they want to know more about what you guys are doing there. How do you walk them through the vertical call spread or the vertical spread in general and kind of the benefits and drawbacks that could offer to them?
Well, typically when we talk about spreads, we're usually dealing with put spreads because, as you know, we're buying protective puts and then selling out of the money puts. But
all right, twist my arm. We can talk about put spreads instead. That's fine. You can do it.
Well, what I tell people is the good and bad is that obviously, like you said, you're reducing your risk. You're spending less premium. In the interim, while the trade is still working, you've got less theta decay every day, and you've also probably got some lower volatility risk. So it's a good way to get some protection on the downside as well as some upside if you're dealing with a call spread. You obviously have to be right about the timing and direction of the market to make money in it. But if you do have a belief in something that's going to happen in the XYZ that we're talking with, it's a good way to make a play without committing a large amount of capital.
Yes, and obviously in the name of the game for a lot of big advisors is, of course, stake management, managing those portfolios, managing and looking for the double and the triple as opposed to the home run every time. And this is a great way to do that by minimizing your outlay at the beginning and putting on these defined risk, defined reward type of trades. Alan, of course, you deal a lot more on the educational side of the fence with the advisors and with the other asset managers out there who are coming to you learning about options for the first time. We deal with a similar audience in some respects on Options Insider as well. One of the things I like about particularly what we're talking about here, the vertical spread, whether it's vertical call or vertical put spread, is it addresses a very significant problem we have with first-time options users, whether they're retail, but also a large number of advisors who are coming to this product for the first time. They see options, they want to get a a meaty quality option like an at the money, perhaps an in the money option, then they see how expensive those are. So they start migrating their liquidity out to, let's say, 30, 20 delta, or even below sometimes calls or puts. And all of us on this show know how that usually works out. The vertical spread is a great way to take that out of the money liquidity, and because you're reducing your initial outlay now, you can migrate that a little closer to at the money. You can pick up a meatier option and put on a spread with a much higher payout potential or probability of paying off than you would if you were just loading up on out-of-the-money calls or puts and swinging for the fences. So do you find that a lot as well with your clients when you're talking to them, people who are coming to OIC, advisors and others to really learn about these products, that it's a great tool for showing them exactly how they can migrate their liquidity to at-the-money and beyond?
Well, the thing is, Mark, we try when we're teaching people about options, they always come in with the speculative approach to options. I think that's the beginning concept of options, is using leverage and taking a directional stance by buying an out-of-money call or out-of-money put. As we all know, this is probably not the best way to implement options into your portfolio. The way to implement options is to mitigate that risk, and using a vertical spread is probably the first building block that any advisor learns, or even any retail client would learn how to mitigate some portion of that risk while taking a stance, either bullish or bearish in the marketplace or on a particular security. So it's a great start. I think it's an easy concept to grasp when you're buying one call, selling another call, having a limited predefined amount of risk in the marketplace, and also, like as you stated before, a capped upside potential. So great start to learning about how options can be implemented into your portfolio.
Yeah, and we like to get into spreads. We delayed it a little bit on this program because there were so many other concepts to talk about first, but once we get into spreads and the different things you could do with spreads, I love that moment, because that's really when the eyes start opening. They start saying, wow, that's what makes the options product a unique thing. This is different than stocks. This is different than bonds. This is different than mutual funds or whatever other products I typically trade in my advisory practice. These are something different entirely, and I could shape them in pretty much any way that I need to meet my needs or the needs of my clients. And they start with that typical vertical spread, and then they start learning from there. They expand into ratio verticals, and then they expand into all the famous wing spreads that everyone loves these days, like the butterflies or perhaps even the iron condors that everyone is enraptured with these days. And they move on to horizontal spreads like time spreads, and it becomes a spreading disease in many ways, but it's a good disease to catch, because it's something that expands upon your options trading and gives you a lot more options, pun intended, many more weapons in your arsenal when you're looking at risk management and risk mitigation for your clients. So let's just do a quick rundown here. We're talking about spreads, and of course, we talked on our first shows about the Greeks and the different metrics that go into calculating an option's risk parameters. The same applies to the spread, is a little bit differently. If you have, let's say in our 100, 105 call example from before on XYZ, if the 100 call has a 50 delta, it's at the money. Let's say the 105 call has a 30 delta. You're going to net out the delta for that. It's going to be a 20 net delta spread. You do the same with all your different Greeks, just like you do with the price of the spread. That's how you determine the net price, the net Greeks of that spread. And as you get a little bit more advanced, you start to learn how the Greeks vary as the underlying approaches one leg of the spread or the other. But that's a very good basic rule of thumb to how to start calculating these spreads, how they perform, and it's something to keep in mind when you're trading these. Another thing to keep in mind, just a little warning, a little advisory for all you advisors out there looking to add these spreads, is that trading spreads in general is a different prospect than if you're just going out and buying a call or just going out and buying a put. Most people have learned these days in the options market, they can just see the NBBO, which is the national best bidder offer. Let's say you're trading XYZ, you see it's $1 at $1.05. If you want to sell that call, you can sell it at $1. You know you can buy it at 105. And if you put the offers, hit that bid, lift that offer, you're going to be filled relatively instantly, and perhaps a couple second delay, but you're going to be filled instantly for the most part. What we see on spreads is a little bit differently. You might have your brokerage firm or whoever's executing your spreads for you you might see an MBBO displayed of $1.02, $1.05. But if you try to hit that bid and lift that offer, it's a little bit different. And the spreads, the execution of spreads is, let's say, a somewhat siloed business where the different exchanges have different spread books and they don't talk to each other very often. So it's a little bit different. We won't go down completely down that rabbit hole now because that's probably, we can fill an entire show with just the vagaries of spread execution between the exchanges and how they talk or perhaps don't talk to each other. But it's just worth knowing that sometimes if you're lifting offers and hitting bids on spreads, you may not be filled right away. You may indeed have to work that spread a little bit more aggressively to get filled. But usually, the end result is worth it for you and for your clients. So that's our quick overview of basic vertical spreads and basic spreads in general. Of course, if you want to learn more, I encourage you to visit either optionseducation.org. Alan and the guys at OIC have some great educational content up there. Of course, you can find a lot more at theoptionsinsider.com. Just type in spread or vertical spread, or indeed listen to the other programs on our radio network where we walk through spreads in great detail. But I want to give you a quick primer here for our end of year episode, a little something to think about as you're looking at your client accounts and what you can start adding to them for 2013 to add a little bit extra bang to their buck, literally and figuratively. So that's it for vertical spreads. Before we go, Randy, Mike, Alan, anything you guys want to add on the spread tip before we dive into the mailbag?
Well, I guess the way I would analyze a vertical call spread in the example of XYZ that we're dealing with today is that you do have your capped upside potential, but I think your probability of profit obviously is much higher because you have less cost in the option trade. So when you're weighting expected returns, I think the probabilities are much more in your favor because you've got lower premium that you're putting into the trade, but you've also got in the interim while the trade is on, you've got lower time decay on a daily basis as well as less volatility risk. So I think overall it increases your probability of profit.
You know, that gets back to the comment we were talking about earlier about the Greeks and improving the Greeks and also just migrating your liquidity a little closer to the at-the-money. The spreads help you accomplish all of that, and that gets to what Randy is talking about, which is, of course, the increased probability of your spread and your position paying off, as well as benefits like decreased decay and things like that because you are writing another contract against it, migrating your liquidity closer to the at-the-money, which is usually preferable for a lot of the customers and clients out there who are looking for a little bit more meat on the bones, if you will, from a Greek's perspective. There are certainly a lot of benefits from that you can get from spreading, which is why we definitely couldn't finish out 2013 with at least touching on the concepts of spreads and vertical spreads. I think in future shows we can get into a lot of different spreading strategies that may interest advisors, like those proverbial spreads with wings like the iron condors, and of course some of the other spreads you can do with options and stock and things, as well as stock replacement strategies and other things like that you can do with options that could improve the overall performance of your accounts. But for right now, this is our overview, like we said, of vertical spreads and spreads in general. For more information, check out optionseducation.org or theoptionsinsider.com for more information on that. And now, because it is our final show for the year, we wanted to do something a little bit different. We know a lot of you guys write in with questions and comments for this show. Your number one question is, when are we going to get more episodes of Advisor's Option? We're working on it. We're getting it out on a more regular basis again, so you should have at least one episode a month to look forward to. So we're working on the frequency, so we hear you on that, so no need to write in on that. But a lot of you have also written in with a lot of other great questions, and we thought this is a good time, end of the year, to open up the mailbag and give you guys a chance to sound off and join in on the program. So without further ado, let's open up the mailbag and see what you, the listener, has to say.
Listener mail. Listeners write in.
Mailbox.
All right, first up, we have a question from Tony. He's a CFP coming out of Glendale, Arizona, and he has more of a comment for us than a question, but he's heaping his love upon the program, so we thought, what better to include in this end of the year show than kicking it off with a little bit of praise for the old program. We want to thank you for that in advance, Tony. Tony writes, "Thank you for this insightful program. I typed the terms financial planner and options into the iTunes search bar on a whim and was amazed to find the Advisor's Option. You have been a godsend for professionals like myself who want to learn more about these products for our clients. I feel much better prepared to deal with their questions now thanks to your program. Thanks again." And Tony, guys like you are the reasons we have this program. It's really to help educate you guys, and like we say at the top of the show, to arm you with more information for proper risk management using options. So we're glad to hear that it's working out for you there in Arizona. So I guess we have one good story, then we've done our duty for the year. Right, Alan?
I think that's music to my ears when I hear something like that. In fact, I think the more advisors learn about the product, Mark, the more they are inclined to provide this type of education to their clients and be able to differentiate their practice from the guy down the street. They can now provide a solution for some clients' risk that doesn't meet the general portfolio theory. A guy who just wants to be bullish or bearish on a particular stock or wants to hedge a concentrated stock position. This is something which options are very well suited to deal with, and more advisors that use these products, the more they have a tool to grow their practice with.
Yes, it's a very competitive field. I mean, we don't have to tell our listeners that. They know that for themselves. It's very, very difficult to make yourself stand out from the crowd in that area. So if you can be the one advisor on your block or in your area who has this knowledge, this skill set to offer, that certainly makes you stand out from the crowd. And it's something that you can then in turn offer to your clients and use that to help grow your practice and your business.
It's definitely a key differentiator, especially in the CFP world. I've gotten a lot of calls in the last year from CPAs, not just CFPs, but CPAs that are looking at their clients trading options saying, what are these things? So a lot of CPAs that haven't dealt with options in the past are telling me they're seeing more and more options coming into their tax preparations for their clients. So I'm sure the show would help out a lot there as well, especially having a guy on the show like Randy who's got the CPA background from KPMG can't hurt as well.
And we certainly won't hold that against Randy being the lone accountant amongst us.
Thank you very much. I would also add one extra point. One of the things that we deal with when we get advisors that we start working with is we really believe that the options, as Alan said, gives a way to differentiate their practice with other people. But we also think it really helps stabilize their business in terms of downside protection when they're able to protect their clients. So typically when most advisors go through large sell-offs in the market, a lot of assets either decline in value or assets leave the firm after that. So this really allows us to help other advisors protect their book of business and their clients.
Yeah, that's a great selling point. If you don't want to live through 08, 09 again, at least not have those same returns, then listen to what we're talking about on this show, because it could help you weather that storm much more effectively. All right, next up, we have a question from Spencer. He is a financial advisor coming to us from Portland, Oregon, and he writes, I mostly deal with retired clients whose assets are tied up in IRAs. I was under the impression that options were prohibited in IRAs. Is that the case? Perhaps you can do a program on options for retirees or people with assets in retirement accounts. Thanks for your one-of-a-kind program, Mark. Well, you're welcome, Spencer. We're glad we could offer that for you. That's an interesting idea. I think we've touched on that a bit already in some of our earlier shows about covered calls and married puts. But the truth of the matter is you can do options in your IRAs. And Alan, I'm sure you get this about 1,000 times a day, so maybe I'll let you run with this one. The answers are very straightforward, but you probably have it down to a science by now.
Yeah, Mark, they really are pretty straightforward. If you have an IRA account, you can do certain strategies within your IRA, and covered calls is probably the most popular one, so we'll stick on that. If you own the underlying shares of a particular ETF or stock, you can sell covered calls against that stock. Now, the advantage to doing this is, of course, that your taxes are deferred, hopefully, until the time when you retire, and you can take those profits out at a much lower tax rate. So there is a distinct advantage in doing them in an IRA account as opposed to doing them in just a straight brokerage account.
Yeah, and what I know about the restrictions on options with an IRA, to my knowledge, some of it comes down to the flexibility of your custodian. Some custodians just flat out say we only allow X, but the only restrictions that I know of are naked call writing, which they do not allow you to do in IRAs. You have to own the underlying. You can't just sell naked calls. You can sell spreads, and most of the proactive custodians will let you sell call spreads or put spreads. then the only other restriction I know of is any amount of leverage. So you can't sell a marginable put. It has to be cash secured.
That's
other
correct.
than those two instances, most of the custodians I've dealt with in the past allow you to trade every other option strategy.
In my experiences, I would agree with Mike. I do have some instances where some custodians will let you do spread orders, calendars and iron butterflies and stuff like that. A lot of them won't, but some of them will. So I think it's up to you to try to find a custodian that will let you do what you want to do within reason.
Maybe we need to put together a list of the most options-friendly custodians out there, so we could start directing advisors toward them, so they could do an Iron Condor and an IRA would be fantastic. And if you think about it, especially from a risk-neutral perspective, there aren't many reasons why they shouldn't be able to do it. You just get down to some of that margin issue again, which is what they all tend to back off on. But an interesting idea, Randy. Maybe that's a future show we can do. We can dive into the best IRA custodians from an options perspective, because that's the kind of thing I think a lot of our listeners would be interested in.
And I think also one of the problems the custodians actually have is they can't differentiate between some of the strategies where we could take a strategy like a calendar spread or a vertical, and you had a $100,000 IRA. Well, technically, you could put the $100,000 into one vertical, and we all know in a couple months that could be all gone, or you could make double your money. That's not a proper use of obviously options in this analysis, and that's where I think the custodians really struggle with. That is the risk management to them of a client not really knowing what they're doing and losing a substantial portion of their capital.
Well, Randy makes a good point there. I mean, remember that it is first and foremost a retirement account. So I think when you're considering doing option strategies within a retirement account, it's probably best suited to use a conservative strategy. And I know plenty of folks who just do simple covered calls or maybe cash secured puts within that IRA account, and that's probably very well suited for retirement purposes.
And next up, we have a question actually for Randy. Randy, I don't know. You've been on the show twice now, and you're already getting listener mail and fan mail. So, I don't know. You're off to a good run here, Randy, it seems like.
Time to start a Facebook page.
Exactly.
All
Don't let it go to your head too quickly. We have a question here from Alexander S., ironically writing in from the other Portland, Maine. He says he's an aspiring financial planner. And he says, I've heard the Advisors Option team, in particular Randy Swan, discussing options overlays in the past. Can you explain exactly what you mean by that term? Do you modify the underlying portfolio to conform to the specifications of the options allocation, or are the options a truly separate component? Also, I listened to a recording of a buy-side panel from the OIC FIA conference in September. One of the fund managers on that panel said he prefers to liquidate his positions rather than purchase protective puts. Why do you think so many advisors, asset managers are still so ignorant of the benefits options offer a portfolio manager? Randy, we'll start, I think, with you and talk about the first part first, because that was obviously addressed to you. Why don't you tell our listeners a little bit what you mean by that term options overlay and what that actually entails?
Sure. At Swan, our strategy is typically buying the S&P 500 and hedging it with puts and doing other option income strategies to generate hopefully monthly income. And what we consider to be the overlay strategy is giving people the opportunity to carve out the underlying, let's say the SPY or the select sector spiders, which is what we primarily use, and replace it with a different basket of stocks or different ETFs. And then what we would continue to do is continue to hedge the portfolio as well as generate income, hopefully using our option trades, our monthly option income trades. So it's just separating out the underlying and having flexibility to look at different underlyings to, some people actually who may feel that their stock picking ability may be better than others, and they really like a certain sector or certain indice or certain components of their strategy, as well as other people who may have some very closely concentrated stock in a company they may work for and say, hey, I've held XYZ, we'll use XYZ. I've held it for the last 30 years and I don't ever want to sell it, but I would love to get some protection as well as maybe sell some calls against those strategies. So that's just what I mean by option overlay.
I think a lot of people think of the term in options position or just adding options to their portfolio and think they have to change what they're doing from an underlying perspective or change their stock allocation, whatever the case may be, but you don't. That's the beauty of an overlay, is that you can do exactly what you're doing now from an underlying perspective, and you can go to a guy like Randy who will put together an overlay for you, which will hedge appropriately for what you're doing with your particular underlying. So that's why they call it an overlay. They lay it on top of what you're doing already. So to answer your question specifically there, Alexander, no, you don't have to. You can pick whatever stocks you want, whatever ratio you want, whatever allocation you want, and then someone can put together an overlay for you, if depending on how wacky your positions are, that will provide that risk management for you without having to worry about the other aspects.
What was the second part, Mark?
The second part of that question was, he says, also, I listened to a recording of a buy-side panel from the OIC FIA conference in September. One of the fund managers on the panel said that he prefers to liquidate his positions rather than purchase protective puts. Why do you think so many advisors/asset managers are still so ignorant of the benefits options offer a portfolio manager? And I have to say, Alexander, I was at that panel. I believe that was Phil's panel at the conference in New York. That was a pretty stunning admission, if I do say so myself. Alan, I know you were there as well. This was obviously your conference. What do you take of that? That comment in general, and also specifically, really, why you think these products are still having such a hard time breaking through?
Well, let's back up a second. I mean, there's all kinds of reasons why an advisor may want to liquidate a position from a client's portfolio, and they just may have grown disenamored with a particular stock, and therefore don't see the need to protect it with a put. I think if you're going to keep a stock in the long term, then I think having a put strategy for that during highly volatile periods is the correct use of the option. To the second part of your question, I think there is still a reluctance to use options widespread in the advisory field, predominantly because I think there was always this mentality of portfolio theory that if I construct a portfolio that is made up of stocks and bonds and cash and a few alternative assets, that portfolio can weather any storm or any inevitability in the marketplace. And I think we've learned now through 2008 crisis that maybe that's not entirely true. And therefore, I think there is now an adoption of using options within the practice and saying, hey, look, you know what? I do need something that's not correlated one-for-one with the marketplace, that is anti-correlated and therefore can protect me. So we are making great strides. I think the options industry in general, is making great strides in getting more advisors to implement option strategies within their practice.
Yes, it certainly has been an uphill battle. I know guys like you and Eric over there really have been doing the lion's share of the heavy lifting, going out to the different firms and educating them on the benefits of these products. I know exactly what Alexander is referring to. It was indeed a very shocking admission. You're right. There are a lot of reasons someone would want to liquidate a position, including all the reasons you described. I think in this particular panel, the person said he chose to, whenever he thought about buying a protective put, that to him was a signal that he had some reservations about that position because he was thinking about hedging his downside risk. So to him, the next logical step was to liquidate that position. It is a bit of an extreme position. It's not exactly it doesn't keep in with a lot of what we're saying here on this show in terms of the hedging and other benefits of options. That was his point of view. I don't think most of us here on this show probably would agree with that. We think hedging with options offers a lot of benefits that liquidating a position certainly does not. But it certainly was a shocking thing to hear. And it's just a good reminder to us here in the options world that in many senses of the word, we are still preaching to the choir. And so that's why we like to do a show like this. We get out to the other industries and the other marketplaces where options are not as widely known, not as widely understood, and we could help spread that message a little bit there. So thank you for your question there, Alexander. I hope your aspiring financial planner career goes off well and you're very successful, and hopefully what we learn from this show and from places like the OIC and from our website help you in that career. All right, next up we have a question from James C. Don't know where he's writing in from. He says, I have a 401k that's invested in the S&P. What's the best way to hedge it outside of the 401k from downside risk? Would beta weighting with SDS be a good hedge, or is there a better way? Also, I've heard the terms hitting offers, lifting bids. I hope I got that right. What does that mean? We'll answer the first part of your question. First, SDS listeners, if you're not familiar with it, is one of those leveraged downside S&P ETF. So essentially, it puts on a leveraged downside. It's an ultra short S&P 500 ETF. And I think, I don't want to speak for everyone on the panel, but I think most of us here on this show take a bit of a dim view of any sort of these leveraged or constructed ETF products, primarily because they're doing what you can do with options, but not as well. If you understand options to any real degree, you can construct a much better short position in the S&P. You can make it ultra short if you want. You can do ratios. You can do whatever you want. Just using the basic concepts you talked about today, like a vertical spread. Take that vertical put spread. There you go. Now you have a limited risk, limited outlay, short position in the S&P 500. You don't have to use something like this. I've often referred to these types of products, a little bit pejoratively perhaps, as the poor man's option. If you want some of the option type benefits but don't want to actually learn about options, people use these. The problem with these is that they don't perform as well as doing it yourself. I don't want to speak for
I would add a couple points.
Go ahead.
I think that using an SDS product like that is probably it's probably an imperfect hedge, number one. Number two, if you're just trying to sidestep the market during an interim time period, then you might as well just sell the 401k in itself and just go into cash. Because obviously doing something like this that would reduce all your downside risk would also take away your upside exposure in the market. So as we would all agree, using options to hedge properly may be the best long-term benefit or the best long-term way to do that. And if you had to do that in a separate account, I guess that would work too.
Yeah, I agree.
I would add.
Yeah, I 100% agree with Randy from the concept that it's a qualified account, so the tax consequence doesn't exist. You know, if it was an individual account where you had some sort of cost basis tax consideration, then, you know, using SPY or SPX puts to define almost portfolio insurance, you know, come up with a number. You can beta weight the number or, you know, use actual real value exposed to the market and come up with the amount of money that you're comfortable using as insurance and then mapping it out, whether you buy a leap put on the S&P or if you're buying monthly put premium or quarterly put premium. But in a qualified account, if you're worried about the downside, it would almost seem more feasible to go to cash. If it's one of those where you've done it before and you've been wrong in the past, then going through the same process of, you know, if you have $100,000 in the account, tying what that would mean to buy put insurance on the SPY or the SPX in a separate account, that would be the way that I would do it.
Yes, there are a number of ways to do it outside of just going with SDS. There are many other better options, pun intended, for ways to do that. Thank you. Oh, and your second part of your question, James C., you asked, what do the terms hitting offers and lifting bids mean? I think we use that a lot on these shows, on this show and other shows on our network. Perhaps we don't think about all the terms we throw around all the time because they're so commonplace to us. I mentioned before the proverbial market, and that XYZ call was $1 bid offered at $1.05. When you're hitting an offer, you're literally just selling it at that. Actually, you're lifting offers and hitting bids. You have it backwards. You're hitting that bid means you're selling it at that bid price. So you'd be selling that option at that $1 bid price. Lifting that offer, you're just buying that offer, so you're paying $1.05 for that. So you had it a little bit backwards there, James, but you had the right idea behind it. So thanks for writing in for that one, James. Last up, we have a question from Orlando T. He's not writing from Orlando. His name is Orlando. This one's for you, Alan, actually. He says, Mark, even though he addresses it to me, I think you're the best person to address this. Mark, your program is uniquely situated to address a serious problem in the advisor community, the lack of any real understanding of hedging and risk management using options. I think everyone on your program will agree options are the best tools for this, yet advisors don't have any substantive training on this subject. Why is that? Why don't the CFA/CFP exams offer more in the way of options instruction? Why doesn't the OIC partner with these organizations or create their own certification exam? It seems to be the only organization that has a shot at solving this problem. Otherwise, we're all poised to recreate 2008, 2009 the next time the market crashes. Now, Alan, you and I have talked about this at length ourselves and some of the pitfalls and drawbacks of OIC doing exactly this. Why don't you tell our listeners why that is a difficult proposition for you guys?
Well, we're not in the certification business, Mark. As you know, we're educators, and we do it pro bono. I would say a couple of things. One, the advisors are very, very bright folks. I mean, to have your own shingle and be an advisor is not an easy thing to do, and it requires a lot of education. And they do have options education. It's part of the 65 exam, to become an advisor. Where I think his frustration lies is that, you have to understand that advisors have to read a tremendous amount in order to keep themselves up on all of the new products that are out there and any of the new research reports that are affecting any of the underlying securities in a client's portfolio. They have to keep track of all of that. So it probably isn't best practice for them to spend all day looking at option strategy, but they do need to be conversant on the topic. They do need to be able to provide a solution or a resolution for a client who has a specific need where an option strategy would be best suited for that particular client. And we are making great strides in that area. I can speak volumes on how, Eric and I do a lot of education for advisory firms across the country. We come to their branch offices, and it's basically not so much as a refresher course, because we know that they have the knowledge, but to give them materials that they too can show their clients on particular strategies that we think are the most common strategies and the most common solutions to client questions. So it's growing. The business is growing. I think the advisory space in the options business will continue to grow. And I say, just watch, Orlando.
You've got some good stuff ahead of you there. I think you're right. It has been an uphill struggle. I think 0809 opened a lot of people's eyes to the benefits of these products and exactly what they have to offer. And so I think that's been really has opened the floodgates in a lot of ways for you guys, Eric, and the rest of you guys at the OIC to really kind of help spread the word about options. And speaking of spreading the word, that's unfortunately all the time we have here for the mailbag on this episode. But I like this. I like giving you guys, the listeners, a chance to chime in on the show as well and get your questions answered. So perhaps we'll make this a regular feature of the show going forward. Perhaps every couple of months we'll open up the mailbag and see what you guys have to say. But unfortunately, that's it for the mailbag for this episode. That's also going to do it for this final episode of the Advisor's Option for 2012. We'll have more episodes, of course, coming very soon in 2013. And before we go, I'd like to check in with all of my fellow panelists here to see what they have going on that may interest you, the listener. Starting with you, Randy, I know you guys really recently just launched your mutual fund, and it seems like it's taking off quite well. Why don't you tell our listeners where they can learn some more about the mutual fund and what you guys offer over there?
Sure. I guess the best way to learn more about our mutual fund as well as our SMA product is just go to our website, swanwealthadvisors.com. We have a lot of information on there, a lot of educational material as well. So that's the best place to get it on us.
So there you go, listeners. Check out the website. You can learn more about the mutual fund and what Randy and the guys do over there from an options overlay perspective. Maybe you're looking to add an overlay to your particular practice or some of your client accounts, and that might be a good place to start in terms of learning about them and seeing how they do it, and maybe asking them what they think about what you have in your various portfolios. And of course, we're also joined, Alan, we were just talking about the initiatives you have over at the OIC to educate advisors. I should also mention you guys do a lot of these great little one-off courses. You do them at Rutgers and other places where advisors can come in and actually get some credit for attending an OIC seminar. So that's maybe something to let them know about when you're doing the next one of those. And also, you mentioned a great service you guys perform at the OIC where you actually come to an advisory firm's office and help educate them on options. So maybe hit on both of those. A, when the next certification type program is coming up where they can get some credit. And then also how an advisory firm can get in contact with you and the OIC if they would like to have you guys come down and explain options in a little bit more detail to them.
Well, yeah, that's a plateful, and the very next event where we're going to provide continuing education credits will be in Philadelphia, and that will take place on March 7th. It'll be an event that is hosted by NASDAQ Market Center, and it will be for both advisors, certified financial planners, even pension managers, and hopefully some endowments as well. We're going to offer CE credit for what will be a 3-hour session on learning how to implement overlay strategies into your portfolio. So that's probably the next big event we'll be doing. As far as advisors coming and asking any of our instructors to come to their office, they can always just call 1-888-OPTIONS. It's a hotline, and your request will be directed to me, and we can make plans to visit your office and do a presentation and bring you up to speed on options if it's been a while for that particular advisor and hasn't used them. And then lastly, the thing I want to also point out, Mark, is we do a lot of evening seminars throughout the country, and we just finalized our list. We put it up on our site at optionseducation.org. There's 48 presentations in all, and the next time I'll be teaching will be in Chicago on the 5th of March, and we'll be doing a very advanced seminar on the Greeks, but there's so many other seminars on that list, both basic, intermediate, and every variation in between. So look at our schedule, and all of these things are free of charge, so we hope we'll see you there.
There you go, advisors. That's the definition of personal service over there at the OIC. So you can call that number, or you can visit optionseducation.org, and you can find out all about those and the many other services that Eric and Alan and everyone else over at the OIC offers for you, the listener. And last but certainly not least, we have good old Mike Cavanaugh over in the land of Know Your Options, Inc., soon to become RCM. You guys are in the process of finalizing that. So what is on the horizon for you guys over there at KYO/RCM, Mike?
That is it. I mean, it's sad and happy at the same time, melancholy and very ambitious of what we're going to do. But we've got about 3 days left of working and operating as Know Your Options. The merger is almost complete, and we will be RCM, which existed as a managed futures and futures brokerage shop, and we're adding the investment piece to it. So we've got an office in Miami. We just opened an office in Louisville, and we're very excited about being able to work with our clients and other advisors in the managed futures and option space. So 3 days till the big rollout.
3 days. Very exciting. You're right. A little bit sad, but also I think an exciting opportunity for the future for you guys, and of course for all your clients and the listeners there today who have now more ways to get in contact with you guys and work with you guys.
Very exciting. I'm excited.
You sound very excited. Dripping with enthusiasm, sir. All right. Thank you for that, Mike. And that, unfortunately, is going to do it for this episode of the Advisor's Option. But, of course, before we go, all of us here on the Advisor's Option panel want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this show and making it such a success over its inaugural year. We're glad we can kind of get it back into the rotation for you. I know a lot of you out there were really excited when the show first launched, took a bit of a hiatus, but now it's back in full force and ready to go with a lot more interesting options content. We have some great ideas and some great plans in store for you in 2013, but we'll get to those very shortly after a little bit of a tease for you, the listener. But until then, have a great new year, and we'll see you next time right here on the Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.